Hey, good morning, everyone. We have got a fairly simple topic for this morning, rather. And so this morning's topic will actually be kind of a little bit more brief, just because it's very straightforward. As you can see, intro to options, expirations, what you need to know, which ones are most important, and then we can talk about quad witching and triple witching, which is actually one we had. I think we had a quad witching last week. I believe it was last Friday. Okay. And what is that? So let's just tackle that real quick and get it out of the way. And you can Google this all you want, but quadruple witching or quad witching is known as basically where you have the 4 different types of contracts expiring. So that's going to be stock index futures, and these are all the derivatives that are traded. So it's going to be it makes trading interesting, because what you think is supposed to happen most likely won't, because you have people getting in and out of their positions, or mainly getting out. So what happens is you've got stock options, stock futures, index options, and index futures all expiring in one day. All right. And it's usually, I think you get like a triple witching. You can look up triple witching dates. And I think there's like for the months involved, I think it's March, September, and then one more. But that's kind of, it's just a matter of if it's triple witching or quadruple witching. If it's triple witching, it's just, the quarterly expiration of stock options, stock index futures, and of course, index options contracts. And then you ask, well, how can we apply this? And well, why is this even important? Well, we're going to get into that. But as I was talking, I just remembered triple witching, if you want to write this down, triple witching happens 4 times a year on the 3rd Friday of March, June, September, and December. Okay. And this is where that kind of the witching hour, the triple witching hour phrase comes from, because it's in the final hour of that day. Okay. So what happens is trading activity and volatility goes haywire because people are going in and out of their positions. So everything just kind of gets escalated a little bit, right? So you're either rolling out of your position for the next week, trying to give yourself another chance, or you're actually getting out, which can cause some major short covering rallies, or it can cause some major what we call puke fests. Okay. So expiring options. Let's go to the option chain. Yeah. All right. So let's talk about expirations. So you're an options trader and you're like, well, hey, I want to just kind of keep it simple and trade something that cash settles like NDX or SPX. And then you go, well, here's the option chain through Thinkorswim, and we could pull up the Doe platform if we wanted to. But uniformly, I just feel like it's better to stick with TOS, just because you'll see a lot of this in the rooms with JC and Henry. You'll see a lot of this throughout any of your options career, just because Thinkorswim is so popular with trading options. All right. So here's SPX. Now, if you'll notice, and we're going to pick out the differences and the similarities with SPX, and then we'll just use Netflix as our other example. You can see that it says weekly, all the way down here. And then it stops, and then you've got the monthlies here. So if it's just right here and it's gray, all it means is this is the AM settled monthly, 17th of April expiration. If you go down a little bit further, you got a May monthly, and these are AM settled. Now look, below both of these, you will see the PM settled. That is the one key difference that is super important to look at. You need to know that your expiration will either be in the morning on the 17th of those monthly expirations for April, or it'll be that Friday afternoon. Okay. So then you go into the calendar of April, and yes, we know that the 17th of April is a Friday. If you want to choose that AM expiration, I believe it's the first 15-minute opening, and then they close it off. At the end of the PM expiration, that's your final bell, and you will get that pretty much, it cash settles. And that's why I like to use SPX, because some people get freaked out about being assigned and all that stuff. But these are your expirations. Okay. Now, if I wanted to go into the end of today and put on a put credit spread in SPX, I would down click this expiration. I would go into vertical, and I would sell an at the money put credit spread. Okay. We know that our expiration is today. We know that it ends at the very end of the session. It's not an AM expiration at all. Okay, now I said we would jump back into Netflix because I'm going to show you something that's a little bit different. This is good to familiarize yourself with. And the reason why I chose SPX is because you have multiple intra-week expirations. So if you want to play an intraday trade on SPX on Monday, or even Tuesday or Wednesday, you can do so. You have multiple expirations. Now you're going to see with Netflix how this changes. And y'all, I realize this is very straightforward, but this is the training room, and the purpose of this is to shorten the learning curve. And you know, for all the new options traders out there, it's important to know your expirations, okay? And what does it mean? It means if you bought some calls, those calls are going to start going worthless the moment you buy them, and they will be expiring on that specific date. Now, if you have something like a butterfly and you're like, hey, I'm gonna have a butterfly in Netflix going out 2 weeks, you're gonna sit back and know that you paid little to nothing, hopefully, for that butterfly. And you'll be specific to that expiration, and the goal would be max profit, right? In any trade, you would want to hopefully have, if you don't have like a profit target, and this is specifically for butterflies, you would know that if you had the 9th of April expiration, you would want to be within your strikes for that butterfly in this particular hypothetical example. And your expirations are always here on the left-hand side. Now, the difference that I wanted to show you was, one, there's no AM settlement for Netflix, and that's a commonality between any of these equities. Okay, so there's no AM settlement. The second thing is whenever you go into these later dated expirations, you'll notice that there is no longer those weekly expirations, because the further you go out with these equities, you're only going to get monthly expirations. Don't think that there's something wrong with your computer. This is normal across most equities, okay? Look at AMD, for example. Okay, same thing there. And look, on Thinkorswim, your monthly will always be in gray unless you change those color settings. Okay? Any questions so far? Like I said, super. And here's a little take. Half the battle with all this options jargon is really not getting intimidated. And I try to knock this in as many times as possible. The first time I heard triple witching and quadrupling, I said, WTF, what are you even talking about? Okay. And then you realize, oh, it just basically means there's 3 different indexes and options contracts expiring all on the same day, which is going to change volatility. And now you know. So whenever you hear John say triple witching or quadruple witching, you just know that you have either stock options and index options and futures all in the same day. And it only happens 4 times a year, right? So why did you hear it last week? It's because we were in the 3rd Friday of March, right? And it's going to happen in June. And this is triple witching: March, June, September, and December. Derivative contracts. Okay. And since I believe it's 2002, this also includes all stock futures as well. Okay. And that's pretty straightforward here. So now you're like, well, okay, that's pretty straightforward. What if you wanted to do like a strategy that has kind of a different expiration? In other words, let's go ahead and do a, all right. So remember, we talked about different expirations, and let's talk about a strategy that involves different expirations. And now this is where I want us to just kind of be careful and think, don't get too intimidated. This is just a strategy to express the importance of knowing your expiration. This is called a calendar, and you're just basically buying and selling two of the same type of contracts. It can be a put calendar, it can be a call calendar. Okay? Now, calendar key term. Why? Because you can see the different expirations. I've got 42 days from the call that I'm buying here that's right at the money to expand. Now, wait a second. Down here, I'm selling a call 13 days out. Okay. And then you go, well, that's kind of interesting. I'm going to buy this for debit. Now, this is expensive, right? This is just a hypothetical example in SPX. So what would be great is if I could actually get a huge bump in SPX, so the market goes higher as soon as possible for this call contract to increase in price. Okay? Then you can either take it off, you can manage it, right? And then what you have is you've got this call down here that you were selling. Now, there's many ways to kind of go through your strategies. Now, this is not basic, but it's important to know whenever you're placing a strategy, know your expirations. And on a call calendar, like you're seeing right here, I benefit from here's the thing, is I benefit from a move to the downside. That's where I should have started. I benefit more from the call going down because I'm selling this one to a nearer expiration 17 days out. And then what you do is you've got this call. And so it's kind of like playing the market both ways. Is the expected move for the particular expiration date, how is that different from triple M? Good question. Thank you for the question. Good to see you, Morris. Do you mean MMM as in like 3M, or is there market maker? Are you talking about the market maker move, MMM? I'm pretty sure you're talking about market maker move. Yeah. Okay. Morris asks, is the expected move for that particular expiration date, and how is that different from the market maker move? Yes. It is the expected move for this particular expiration. And then what you have right here on the percentage side, this is just implied volatility. So based on the percentage base. And do you see how 3M is fun, but let's just go ahead and use something that's going to be supermarket specific, or something that's going to be a little bit more obvious for us. And so we'll just use Amazon as a pretty good staple. Right. So here's the market maker move. We know, okay, now this is awesome. So just pay attention. Right within here around April and May, this implied volatility goes up. Well, why does it do that? Well, let's go to the chart and I'll show you. Let's go to a daily time frame. Zoom out just a little bit. And bada boom, bada bang. Implied volatility increases around earnings. Remember, we went back to this option chain, and that was what, around April monthlies? You see the increase from 35% today and then it kind of decreases after earnings. Important to know. And yes, the market maker move is efficiently priced. Remember, we talked about implied volatility. This is based on not only the move from that's been calculated in week after week after week, but this goes back a year. So implied volatility continues to increase around earnings and decreases once earnings are over. So whenever you're getting more into different option strategies, you can be long volatility or you can be short volatility. Or you can say, hey, I'd like to do, I like my chances here with higher volatility with some in-the-money calls. Then I would like them here with lower implied volatility. Some people like to sell premium in high volatile markets. And this is just little nuggets, one thing at a time. Any questions so far? All right. So the importance of understanding expiration, it's very straightforward. Any questions? Let me go back to the option chain and just make sure that I'm not missing anything. And as far as Thinkorswim, any more type of customizations, there's really not a whole lot here. I mean, you can certainly go through here and you can change, you can detach this, okay, by hitting this little black and white box right here, and it'll give you a new window. Okay. Now, I don't really click on company profile in the option chain. I know as much about as Amazon as I need to, but if you need it, you can just click right there on company profile and it gives you all of its stuff. Okay, and by stuff, I mean valuations, percentage, profits. You know, obviously you can see Amazon Web Services way more profitable than Amazon itself. And that 7% difference is huge. So there you go. Let's see here. So I wanted to just keep it simple and straightforward. That's the importance. Know your expiration. And then you're like, okay, well, I'm going to trade SPX and I would like to do something like a put credit spread, but I'm not extremely bullish. And, you know, we might trade sideways for a week or two. This is all hypothetical to bring a point across. So let me give myself some time on this. And whenever I started trading options, I was the earliest that I was choosing my expirations with 2 weeks. It was 2 weeks. Like I wouldn't do a day trade. I was a scaredy cat, you know, and I started out opposite as to most people in the options world. I started out with a huge account. So a lot of y'all that follow TG with stocks, right? He's got a great system where it's just boom, 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 and we'll take the stock percentages gains. That's what whenever I was just starting out, just young and just hanging out with my grandfather, that's what I did. Okay. And I turned 12K into 88K and, you know, that kind of went back and forth down to 60K. And then I found myself starting out with an options account with 88,000 at the ripe young age of, oh man, I'd have to go through all my bank statements here. I don't even know if I have Vanguard. So I didn't start with a small account. And guess what happened to that big account? I blew it up. And I'm open about that because it's my journey. And I started so super fast. So many mistakes looking back. And yeah, you know, I probably got some gray hairs and lost some hair over it. But I just want to let you know that you're listening to someone that started out big and strong, right? And just got all the lessons handed to me on a silver platter. So I've been there, I've done that, right? And a lot about learning options is having a setup and letting that setup play out. Okay. I'm trying to pull up I think I still have it. I would love to pull this up. I am mindful of the time. Like I said, I've got this, All right, there we go. There's one picture of my old first brokerage account there, 63,000, and then this one is turning this one into 73, and then of course they go higher into 88, and then it just shows in between my fluctuations. The reason why I've saved those is just because it's just good to have, right? It's good to look back and be like, remember all those painful lessons? You don't have to repeat them, Jack. You really don't. And whenever you get more and more into this, you start realizing that those lessons are super, super painful and you don't want to repeat them.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me over.